Okay, guys, welcome. Today is the 20th of March, and this is the second webinar of the month that we're doing. Today, I'm going to discuss technical analysis because in the last webinar, one of our attendees asked how you do technical analysis, which is how do you read stock charts. And also, as in our community, which is a free Telegram community, there have been a lot of amazing questions people ask. I also keep sharing information. In the description of this recording, you're going to find a link to our Telegram channel. So please connect with us. It's free, and it'll give you an opportunity to connect with some like-minded people who are also very interested in learning about stock investments and the markets in general. Today, what I'm going to discuss with you is technical analysis, which is the art of reading stock charts. But I want to caution you. Technical analysis is used by traders to do buy and sell. So enter, exit, enter, exit. I'm also going to be using a lot of charts, and I'll show you what trends are showing. But please do not misconstrue it as advice for me to go buy or sell those stocks or to trade or invest. Because today I'm going to get very hands-on with you all, and you're going to see signals, like a lot of things that I look at. But I'm going to try my best to focus it from the point of view of an investor. Remember, an investor buys and holds. The first and foremost thing we do is we first identify great quality stocks or great quality companies. Because at the end of the day, we are investing in a company. And how do we pick up a great quality company? You got to look at the fundamental analysis. You got to look at their financial statements. You have to look at the long-term behavior of that stock. You can use discounted cash flow. You can use a whole bunch of various other mechanisms to estimate the fair market value. Once you've done all that and you've determined what your portfolio mix is going to be and you're ready to take a position in a stock, you can use technical analysis as a further addition to see whether your entry is a good entry or not. I don't like to buy anything the fair market value. But typically, let's just say I don't buy above the fair market value. So if the fair market value is 100, my entries are below that. Now I use technical analysis after that to identify what the buy points are going to be. So if $100 is the fair market value, I can use technical analysis to identify that maybe 80, 70, and 60 are good buy points. And why are those good buy points? Because there are support levels at that time, which means the stock goes and then it picks back up. And then what I do is I use the concept of dollar cost averaging. So I never put in all my money in one basket. And I keep telling this over and over again because it's very important, because in the short term, market misbehaves or market is very emotional. So if you pick up a stock of a certain company, you had pre-allocated a certain amount and you deploy all of that in one shot, guess what? Your cash is fully allocated. Either you go find money from somewhere else or you wait for the next time when you have more money. Ideally, what I do is I say, let's say if I have $1,000 to invest towards a certain stock, I break it in 4 or 5 tranches. So if the stock hits my first buy point based on my technical analysis, after I've done my intrinsic value calculation and fundamental analysis, then I'll say, okay, maybe I'll put in $200 at this time. When it hits the next buy point, which I've determined through technical analysis, then I'll deploy another $200. That's a fundamental, and I really want you guys to understand. So moving on, let's get going. So what is technical analysis? Technical analysis, folks, is basically the art of reading stock charts. And within that, I'm first going to talk to you about candlesticks, because I don't read line charts, I read candlesticks. Then we'll talk about what are trends. So you can actually look at a chart and tell whether stock is going higher, whether it's like trending up, trending down, or whether it's trending sideways. A lot of times you'll be surprised after you learn all this, you'll be surprised how many of your peers have no clue what this is and just blindly going by. And then I'll talk about moving averages that go to support what the visually what you can see in trends. Moving averages can go and support that. And there are also some more information that they can give you. They can sometimes give you an early indication of a market change or a trend change, which is also called trend reversal. And lastly, we'll talk about support and resistances. But after all that, I'm going to move into 2 indicators. One is MACD and one is RSI. And I'm going to show you how to connect all those together. So today's presentation is going to be long, but I think it's going to be full of a lot of knowledgeable information for you all. Okay, so this is what a candle chart is. Now, why a candle chart? So when you look at your Apple stocks, it's an app that you have, you'll just see a line chart, right? You'll see something like this. But this gives me very limited information. I don't like to use that. I like to look at a candlestick because a candlestick gives me a whole lot of information. It gives me an open, it gives me all day high, it gives me a close, it also gives me all day low. And appearances also tell a lot. So let's go to this. So here is a candlestick. Typically the green is represented as bullish and red is represented as bearish. But what that actually means is that every candlestick has two main parts to it. So one is called a body. So body is this solid part, okay? And the other is called a wick. So there is an upper wick and there's a lower wick. What you can see here is that when the stock opens, if it's going to be a green day, the opening price is going to be the bottom part right here. So this is the opening price. And then the stock is going to go up and down all day. The solid part or the rectangle represents the body, which means the bottom is the opening price and the top is the closing price. And the wick represents all the way the high and the low the stock took. The same goes with bearish, but it's flipped. The opening price is at the top and the closing price is at the bottom. And then the days up and down are shown here. Now, what does this tell me? It tells me whether, right away I can tell whether if I look at the color, it was a bullish day or a bearish day. That means it was a bullish day. If the stock went up. If it was red, it was a bearish day. But it actually tells me some more information about the nature of the performance or the behavior of the stock that day. Sometimes you'll notice that a stock has a small body and it has a small upper wick, but a very long bottom wick, okay? Very long. What does this tell me? It tells me that the stock opened here and during the day, it went all the way down, which means there was a bearish momentum during that day. So it went all the way down. But this is where bulls came in, which means people who thought that the stock was cheap came in and started buying the stock and they pushed the stock right back up. That shows a momentum of some kind, which means it shows the psyche, the behavior, the feelings of the retail investors or the majority of the investors at that time. So it shows that this state of the feeling on the stock was that that price was low, so a lot of people came in to buy. And when they came in to buy, the stock went up and it closed here. So opened here, closed here, but during the day, there was a very bullish momentum. If the candlestick looks something like this, where the color actually is irrelevant, it could be red or it could be green. Basically what this means is, or what this is, that if the stock had a body with the wicks almost equal, and they're pretty long, even this is short, let's say they're much longer. So if it's something like this, like much longer wicks, what this basically means is the market was neutral. They really didn't know where the market should go. There was no specific bias. The market went up, but the retail investors started selling, so it went right down. It also went down, but there were people who came in to buy, so the market went right back up. So oftentimes you'll also see this behavior. So that means that a trend is not necessarily set up. Now, you may also see a behavior like this, where the body is small, but the upper wick is very high. This means that while the stock opened here, it went all the way to the top, but the investors thought the price was too high and they started selling and they brought the price right back down here. It also went further down, but came back up and it closed here. So opened here, closed here. This shows a bearish sentiment that day. So a candlestick is able to give you that much information. Now, if you go into further exploration of candlesticks, you'll notice there's a science just on this. Candlesticks were invented by somebody in Japan. And there are many patterns. If one candle is like this, another one is bigger like that, or there's an engulfing candle, they all show different things about the behaviors of the market. And there are a lot of resources online that you can read. For long-term investors, we want to look at the overall trends. Although this information is very useful, we want to look at the overall trends. Okay? Now, why am I talking about trend? Because there is a saying in the world of investments, and that is called, your trend is your friend until it ends. Okay? So what does that mean? So in the world of technical analysis, a stock that is already in an uptrend has a higher probability of continuing in that trend. And a stock that is in downtrend has a higher probability of continuing in that trend. So what do I mean by that? What I mean by that is, first of all, what is an uptrend? So if I were to say uptrend is basically referred to as a behavior of a stock which marks higher highs and higher lows. So if I were to show a behavior of a stock like this, which goes up in this zigzag pattern. So this is a low, This is a low, this is a low, and this is a low, right? And this is a high, this is a high, this is a high. In an uptrend, this high is going to be higher than the previous high, and this high is going to be higher than the previous high. So notice there's a gap, right? Same with lows. This low is going to be lower than this low, or this second low is going to be higher than the first low. And the third low is going to be higher than the second low, and the fourth low is going to be higher than the third low. So this is generally what can tell you whether the stock is heading in an uptrend or a downtrend. And soon I'm going to show you some charts that can very quickly tell you whether the stock is an uptrend or a downtrend. Now, why am I talking about, actually before that, now let's look at the downtrend as well. So a downtrend is like this. So the high, and the high. So let's say this is high 1, high 2, high 3. And this is low 1, low 2, low 3. Higher 2 is lower than higher 1, and higher 3 is lower than higher 2. So this shows that this stock right now is making lower highs, and same with lower lows. So it's making lower lows. Why? Because L2 is lower than L1, and L3 is lower than L2. So this is an uptrend, and this is a downtrend. That's very important to understand. Now, the idea, so remember I said that a pre-established trend has a probability of, a very high probability of continuing in that trend. So if a stock, if you can zoom out and see in a weekly or monthly, and the stock has an uptrend, the chances of it continuing in that are very high. So if the stock overall is heading in up direction, it may be going up and down. The chances are that if the stock is picked up somewhere here, in a few months, it's going to be actually higher. Now, in the short term, it may go zigzag, right? Go up and down. So that's what this means. You can also consider this the Newton's first law of motion, which basically states that any object in motion stays in that motion unless acted upon by an external unbalanced force. Similarly, stock markets tend to move in the same direction unless a significant event or a technical indicator signals a shift. Okay, so I already told you how you identify trends, but how do you identify reversals? You can identify reversals based on if a stock is going up like this, and then suddenly it starts to make lower lows and lower highs, and then you're like, okay, it's changed positions. You can also use moving averages, which I'm going to talk about in a bit. You can also use indicators that tell you whether there is some kind of a reversal in the trend. Today, like I said, I'm going to talk about RSI and MACD. Now, here are some charts, and let's analyze them. These are actually real companies, but again, I want to caution you, these are not buy or sell recommendations by me. I don't want you guys going and saying, oh, Amit showed this chart, let me just go and short this company. Please don't do that. This is just for example purposes, for education. So here's a chart. It's a company I just found, Murphy Oil Corporation. And this is their stock of how it's behaving right now. When you look at this chart, what does it tell you? I think it should tell you that this is a downtrend. And why should it tell you a downtrend? Notice here, this stock is going down, zigzag. Check this out. In a very normal textbook downtrend. And why is that? Because here was a high, another high, this high is lower, next high is lower, another high is lower, high. So it's making lower highs. What about lower lows? Is it making lower lows? Let's have a look at that. Here's a low, 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 here's a low. So it's also making lower lows. This shows it's in a downtrend. Let's look at another one. Here's another chart. This is called the Health Sciences, however you pronounce it. I have no investments in these stocks, but I just got them from TradingView today. Look at this. And I also don't know anything about these companies, just for your information. But for technical analysis, that's why I'm showing you this. Is this making lower highs? Yes. Look at this. You can similarly go and analyze any stock that interests you to give it a look. Draw it out or open it in TradingView and see how is it behaving. Is it making higher highs or lower highs? In this case, it's lower highs. And it's also making lower lows. So overall, it's a downtrend. Carrying on. Here is a chart of something that's going up. So this is the GSM, Grosvenor, whatever the stock is. Again, I don't know the stock. It's not a recommendation. Just we're doing this for technical analysis purposes. Look at this. So it's making higher highs and it's making higher lows. Again, textbook uptrend. Here's another one. So these are very easy to point whether if something is an established uptrend, chances of it continuing in that way are higher unless something happens either to the company or to the stock. And in the short term, let's say you were in this company, right? In the short term, it started to go down. But let's say it was a monthly chart and overall the stock was going up. But when you come here and it's starting to go down, you'd be very worried. So look at the higher trend. If it's going down, you got to analyze, of course, a fundamental, etc. But if you just purely look at the technical analysis, if it has an established uptrend, chances of it going up are very high. Unless when you look at, like I mentioned, if you look at the moving averages and something in that larger time frame has now flipped, like the crossovers or golden crossovers, then they start to tell you that, okay, the trend is changing. Maybe I need to do something. If the company is still strong as an investor, if the company is still strong and there's a short-term downtrend, I will assess. I may not necessarily exit the position. I'll probably just hold it. I may not even add more, or I may add more. It really depends on individual stock. Okay. But I do want to tell you one thing, that if you notice, stock never goes up in a straight line. It never goes up in a straight line. Like, it always goes in a zigzag pattern. So a very quick thing that technical analysis could teach you is that if it's doing the zigzag, perhaps if the stock is at an all-time high at that moment, maybe you don't want to buy it at that time, right? Maybe you wanted to let it breathe out. So if the stock was like breathing in and it goes up, then it has to breathe out. If it's breathing in again, but don't buy it when it's at the very top. That's something that you can very quickly see by looking at the technical chart patterns. Here is another stock that is moving on a sideways pattern. So what does sideways mean? It means it goes something like this: up, down, up, down, up, down, where you can draw a top and a bottom. You know, it hits here and goes down, and then hits here and it goes up. This is called a resistance, and this is called a support. So check the stock out. So where are the highs, or what is this pattern looking like? So one is that there is a high here, so something here, and then there's a low here, so there is a chart that's progressing like this. So there is a support and a resistance, right? So this is your resistance, this is your support. Now here, what's happening? Look at this. Turn around. You can almost create a straight line here. So here is a resistance. Support. Support means where it bounces and goes right back up. Check it out here. You can create these patterns in every chart has these patterns. So if you know that the stock has a sideways pattern, and let's say you're interested in procuring it, what would not be a good place to pick it up? The not so good place would be at the top. But what also happens sometimes is there is a breakout. So in a breakout, look at the breakdown, for example. So here, stock came, it was supposed to be a support, but then had a huge candle down. So this support became ultimately a resistance. So this is called a breakdown. The same thing happens in a breakup or a breakout. So if a stock goes like this and there's a breakout, and let's say there's a very strong candle and the stock picks up after that, oftentimes it may come down and test this previous resistance. And if it tests and goes right back up, that basically what that means is the resistance has become a support. And now it's going to be very difficult for it to break down. It's going to basically go up after that, or it's going to keep bouncing and this is going to become another support. In this specific stock, that's very evident. Notice, stock went down. Whatever was supposed to be a support before ended up becoming, so support, why? Because it was bouncing up. And here too, it was bouncing up. But when it broke below, that support became a resistance. Now the stock is not able to beat this. It's bouncing and going right down. So that's called, again, I'm going to talk more about this, but this is essentially a very common behavior that happens in the stock market where a support becomes a resistance. But you first have to identify what are the support, which means where does the stock touch and go right back up? Or where does it touch and go right back down, etc., etc. Okay. Here's another stock chart that gives you a very similar kind of a behavior. And how do you know that? Look at this. The stock first touched here, then it broke through the resistance, and now that resistance became a support. Look at this. It created one level of support here. By the way, it's also important to know that what is considered a strong support and a strong resistance. Typically, any pivot points in a stock chart that are tested twice. If it's tested twice and it goes back, That's a resistance in this case. And same thing would be on the other side too. A strong resistance or a support is if something gets tested or a point gets tested 3 times. So 2x is support, let's say resistance. 3x is a strong resistance. And the same thing with support. So in this case, this was tested 3 times. So this was strong. But then when it came here, it broke through strong. The resistance kept getting tested many times. So this is a very strong resistance. So if you look at the stock going up, chances of it going right back down are very high. Why? Because it's been tested so many times. And now the support level has also been tested many times. So what is that support level? Look at this. 1, 2, 3, 4, 5, 6, 7. Here it touched back down, but came right back up. So this is called a double bottom. So when an institutional investor wants to, because unfortunately a lot of markets are manipulated in the short term. So what they would do is they would sell so many stocks and sell them so far below the points where a lot of people have their stop losses that their stop losses would get triggered. This stock is going to go down, and then these institutional investors will start buying again and bring the stock right back up. And especially this has happened a double dip. So this becomes goes to show that it's a strong support level. Anyways, a lot of technical analysis conversations can be had, and there's a lot of philosophy behind it. But I want to introduce you to the high levels because this will start to give you an idea of what you're looking at when you look at a stock chart. Okay, now we can also support the technical analysis where I was visually showing you how you see an uptrend and downtrend using what's called moving averages. Okay. And I'm not sure how many of you actually know what a moving average is, but basically a moving average is the average of a stock's closing price over a set period of time, giving equal weight to all prices. And this is called a simple moving average. There's also an exponential moving average. So a simple moving average basically takes an average and it gives the same weightage to all prices in the past. And in the past depends on the duration. So it could be a 50-day, a 100-day, a 150-day, and a 200-day. And the moving average smooths out the performance of the stock. So instead of seeing up and down like this, it just gives you a smoother line. So you can just very quickly say that, okay, it's up, sideways, or downwards. A very strong, simple moving average level is a 200-day moving average, which is right here. So if the stock chart, if this 200-day moving average is sloping upwards, that means a long-term uptrend. And why 200? Because that almost represents a full year. So if over a full year it's sloping up, or the 200-day moving average is sloping up, then that means that over the course of average of 200 days, roughly a year, the stock has been going up, and that's a good sign, right? So because of the 200-day moving average, the other averages that I like to look at are basically fractions of the 200-day. So 200-day moving average. So then I look at 150-day, which is again a fraction by a 50 or a division, or if I take 50 and essentially it's a fraction. So there's a sequence to it. So 150-day, then I look at the 100-day and then I look at the 50-day. So 50 times 2 is 100, then add 50 to it, that's 150, and then that add another 100, that's 200. So that's a reason why I like to look at 200-day, 150-day, 100-day, and 50-day. And I'm not the only one. A lot of investors also look at the same kind of moving averages. But this is the science behind the madness. Why 100-day, 150-day? Because 200-day moving average is a very strong moving average. Okay. Now, another kind of moving average is an exponential moving average. Exponential moving average is also something that gives you an average of the previous, but it uses exponential concept. So instead of straight addition, subtraction, it uses exponential concept, which basically means the recent days get more weightage. What that does is the exponential moving average sticks more closely to the movement of the stock chart. As investors, we use in the way that we zoom out the chart and we can see that what are the overall patterns of the chart. Does it on a common basis, does it bounce on a 50-day moving average? Does it bounce on a 200-day moving average? So those are some of the additional things I will say that we use, because not only is a support and resistance calculated or found by seeing the price point at which the stock turns, but moving averages also behave as supports and resistances. So let's carry on and have a look at that. So here is a stock chart of Apple. And it's actually very recent. So I also just got a screenshot of this today. So what this is showing is that the long-term behavior, where I am showing a 200-day moving average, a 150-day moving average, 100-day, 50-day simple moving averages are recognized right here. And if you notice that they are clearly fanned, which means the 50-day is greater than 100-day simple moving average, which is greater than 150-day simple moving average, which is greater than 200-day simple moving average. And when that happens, which means there's a clear fan. By the way, guys, I just noticed that there is a color problem in my legend. The 50-day is actually a blue, and the 150-day is green. Excuse me. I've also created an indicator for you all, which you can freely use from TradingView, because what TradingView does is it doesn't allow you to add more than 2 indicators freely. So I just wrote a script which gives you the 4 moving averages and 4 simple moving averages and 2 exponential moving averages that you can just use immediately. And I had shared a link to that in our Telegram channel. So if for those of you who are in the Telegram channel, just join the Telegram and you can see the link in the history. An established trend is going to show a fully fanned version of the moving averages, which means 50 is greater than 20. So you notice this is 50 simple moving average. It's higher than the 100-day moving average. So that's good. And the 100-day moving average is higher than the 150-day moving average. So that's good. And then 150-day moving average is higher than the 200-day moving average. So that is good. The exponential moving averages in this case are the thinner lines. I was trying to do a dotted line in TradingView, but TradingView doesn't allow me to do dotted lines. So I just did it very thin. So there are 2 of them. So one is a 20 exponential and a 40 exponential moving average. And they're also trending up. That means this stock is also on an uptrend. Now, notice in the short term, this stock, obviously, like any other stock or the index, is not going to go in the straight line. So it's going to go up and down. But as investors, what we could do is zoom this out. And this is right now zoomed out in a monthly candlestick, which means each candle represents a movement or behavior of the stock in 1 month. So when you zoom out in a month, and you could do it on a week as well, start to show you the long-term patterns, because we are long-term investors. So long-term patterns is what's important. So you'd be like, all right, this stock, when it goes down, seems to touch the blue line. And what is a blue line? On a monthly moving chart, the blue line represents the 50-day moving average, or in this case, a 50-month moving average. So 50. But in 2009, it dipped to blue moving average, and the rest of the time it comes close to the blue simple moving average, which is the 50-day simple moving average. But is there anywhere else it goes to mostly? Yeah, it shows that the exponential moving average might be touched a little more. Again, we're looking at the long term. This is how you can start to identify patterns. Okay. So I have already explained to you what the fanning of simple moving averages is. So in this case, a fanning of the simple moving averages, again, this is the SPY, which is an ETF that tracks the S&P 500. So notice that the SPY is showing right here, SPY, this is a daily chart. So what is the daily chart showing? That the S&P 500, when it dips, mostly it touches the green line. And what is the green line? The green line is the 50-day simple moving average. Long-term pattern, even on a daily chart, because the 50 is above 100, which is above 150, which is above 200-day moving average. This means this is in an uptrend. Right now, we currently know the stock has hit down, but so be it. At least in the long run, it's moving up. Now, what I don't recall, when I copied this chart, I may not have copied all the way till, actually, no, I did not copy it all the way till now. I think I just wanted to show you guys that what an established long-term uptrend looks like. And this was up until December of 2024. So last year. When you can take this as a homework, have a look at the chart yourself in TradingView and see how it's behaving in the short term. This is what a downturn looks like. And I'm now showing it using the simple moving average and the exponential moving average. If it's an established downturn and you don't want to visually see whether it's making lower lows and lower highs, you can look at the moving averages. Just put the same moving averages. And if it's an established downtrend, and this is a daily moving chart, you can do that for a monthly, weekly as well. But in this case, the 50 simple moving average is less than 100 simple moving average, which is less than 150-day, and then which is less than 200-day simple moving average. In other words, the 200-day simple moving average, which is right here, the red one, is higher than the 150-day, and which is higher than the 100-day, which is higher than 50-day. This is the opposite, and they're all sloping downwards, right? That is a bearish sequence. So sloping down, and they're in the pattern of the greater than less than I just told you about. Other thing is, if the stock price is below a 200-day simple moving average, so let's say stock is going up, but suddenly something happens, and this was a 200-day simple moving average, and the stock goes below it, that is a bearish signal. But when I would call it a downturn or an early indication of a downturn is that the 200-day simple moving average, I like it to slope downwards. When that happens and the stock price is below the 200-day simple moving average, that is an indication the stock has turned from a bullish to a bearish. So these are some of the indicators that you can look at. There are also crossovers. So if a 50-day simple moving average crosses below a 150-day moving average, that's an early indication of a bullish trend turning bearish trend. And if a 50-day moving average crosses below a 200-day moving average, that's, you can say, yes, that is a downturn. That's established. But I also like to see that both of them have to be sloping downwards. Now, as long-term investors, what are points of purchase? If it's an established uptrend and let's say the intrinsic value is here, this is the intrinsic value, then the dips are typically good points to enter. And it'd be wise to also find out the supports and resistances, which I'm going to discuss in the next slide. So what is a support and resistance? Support and resistance are basically concepts in technical analysis that help investors identify price levels where the stock may change direction. Okay, what does that mean? So let's say if the stock is behaving like this, going tick, 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 at which point do we think it's going to change? And when it falls down and it shifts up, that's called a support. And I'll go into more of how to identify that very soon. Although in the last few slides, I showed you a little bit of that. I introduced you to it. Now, while these levels do not guarantee price movements, they can provide a historical reference point that help investors analyze trends. What is a support? A support is a price where stock has historically buying interest. So let's say the stock is going down and suddenly it shoots up. What actually happens is that investors come in and say, oh, this is a fantastic price. And a lot of investors suddenly come and the short-term downward spiral of the stock turns around and it becomes an upward movement. That is called a support. And what is a resistance? A resistance is when the stock goes up and it's a price where the selling interest has previously emerged. It comes to a point and suddenly investors or traders like, okay, it's way too expensive. We're going to get rid of the stock. That's when it turns around. As investors, we don't do that necessarily. Now, again, it's not one size fit all, but as investors, we look at the longer term trends, but still, this is what shows what a resistance is. Now, obviously, we need to look at whether it's a strong resistance, whether it's a weak resistance. And remember there, I was telling you whether if the resistance or support has been touched or proven more than 2 times, it becomes a strong support or resistance. All right. So here's a chart. Let's find support levels. Remember what support level is. Support level is when the stock goes down and then bounces right back up. So this is how you find them. The best way and the easiest way to find a support is find pivot points. So let's call it a swing high. So this, or swing low, let's call it or swing up. Let's call it a swing up. So which are swing up points? So here's a swing up point. Here's a swing up point. Here's a swing up, here's swing up, here's swing up, here's swing up, here's swing up. Here's a swing up, okay? And these swing up points end up essentially showing that these are support levels. So in this case, this swing up point was tested twice. Then here's another swing up. This was tested 3 times, 1, 2, 3. Then here's another swing up. This was not tested. But if you were to say this was a zone, then you can say, okay, this is something that was tested a few times. This is a strong support, etc. And what is a resistance? Let's give the same look. Resistance is a swing down. So that means goes up and then comes right down. Where is the resistance? Resistance here. Notice we can draw a pretty nice line here. And it carries on. This line can continue. So this is a strong resistance. This is almost the same level. Notice this. So this stock has a strong resistance somewhere around the price point of between $28 and $30. Let's say $29, it has a strong resistance. That means up until this point, which was July, whenever the stock turned to 29, a lot of investors thought the stock was overpriced and they would just sell it. Then the stock broke above this resistance. Then it went straight up after that. But even here, you can find supports and resistances. So check this out. So here is a support level, and here is a resistance level. And if you notice that this support level was earlier a resistance. So when the stock broke above it, the resistance became a support. So if this was a resistance, it ended up becoming a support and it went up. So now the question comes, how do we use supports and resistances? Okay. So remember, as long-term investors, this helps us understand the historical support and resistance, and it helps assess the stock's overall trend. Some investors monitor support levels when assessing long-term value opportunities. And if a stock moves above the long-term resistance, then some may consider that as a sign of strength. And if a stock moves below the long-term support level, that's a sign of they have to reassess their thesis. So understanding support and resistance is one of many tools that investors use when analyzing stocks. So here is the stock moving like this. At this very moment, you're trying to enter and the stock is somewhere here. You're able to see that, okay, there was a resistance at this point. And if the stock is here, and also there's a support at this point. So if the stock is here, you can just very quickly gauge and say, you know what, let me wait to see, let the stock come down somewhere here and then I'll purchase it. Again, you will do that after you've figured out what the fair market value is. But again, everybody has different thesis, so I'm not here to influence that. But that's essentially what the stock is going to be telling you. And let's say the stock here breaks beyond the resistance level and goes up. Typically, it would come to test the resistance again. And if it bounces right back, then what happens is that this resistance now, so this was earlier resistance, now it becomes a support. Now the stock is typically going to go up. Even if it comes down, it's going to touch the support and go right back up. And again, why? Because that's just the behavior of how stocks typically behave. I had also mentioned to you that the moving averages also work as supports and resistances. So let's say the moving average is also progressing in the following way along with the stock. You may notice that stock will come, hit a certain kind of a moving average and bounce right back up. So let's say if this resistance also corresponds with a moving average, then actually that ends up becoming a very strong support level. These are just things when you play with the charts, you'll start to notice these patterns. So a resistance level that coincides with a moving average's support becomes a strong support. It's very difficult to break that. So if a stock goes below that, there's got to be very strong momentum. If you notice in the Telegram group, I had spoken about a level of the S&P 500, that this is a strong resistance. If the stock breaks above it, there's a very high chance of it carrying on. Again, it's a chance. We don't really know. Over the last few days, it kept touching that and going down. There was a day it went up, then it went right back down and again touched it. So that it's basically playing out the same story, which is a typical support and resistance, and it's doing the same thing. Now, if it carries on beyond that with a strong momentum, then there's a chance that the market will carry on in its upward trajectory. But we'll have to wait and watch. Now, what I want to show you is I want to start talking about some indicators. Today, I'm going to talk about two indicators. One is MACD, another is RSI. And these are good indicators, but it's very important to understand that indicators cannot be used in isolation. Okay, I have done back tests using Python, and I've run trades based on some patterns of these popular indicators. And I tell you, the resulting performance is much lower than just buying and holding a stock. Again, please use this as something that helps you better understand what's happening in the market, but not necessarily as something that you use to buy and sell. So what is MACD? MACD is an acronym for Moving Average Convergence and Divergence. And it's a momentum-based indicator that helps you identify the strength of a trend and the potential shifts in the markets. Okay, and it consists of two lines. One is called a MACD line, and other is called a signal line. It also has a histogram. Histogram is basically lines that go up and down. And I'm going to show you in the next chart what that, or next slide what that is. But those histograms also help basically understand the momentum. So how do you read the MACD indicator? So MACD has, the first line is called the MACD line. And MACD line is produced by two lines. One is called a 12-day exponential moving average, and other is called a 26-day exponential moving average. So what this does, the MACD line actually subtracts the 26-day moving average from 12-day moving average. And the signal is a 9-day EMA. It helps obviously smooth out the curves, but the behavior of the MACD line in comparison to the signal line, which is a 9 exponential moving average, now starts to tell you whether it's a bullish momentum, bearish momentum, whether the momentum is increasing, whether it's reducing. So just as one indicator gives you that much more information. Okay? And histogram, as I mentioned, is the difference between the MACD line and the signal line, and it shows the strength of the momentum. So how can long-term investors use MACD? So first of all, it helps identify trends. When MACD is above 0, it suggests an uptrend. And when it's below 0, it suggests a downtrend. So I'm going to show you, this is what a MACD line looks like, right? And another one is, it's going to be in a different color, but I'll just draw it. Another one is going to be a signal line. So when a MACD is above 0, so this is a 0 line. So when a MACD is above 0, it suggests an uptrend. When it's below 0, it suggests a downtrend. Now, of course, you can also visually see it by looking at the chart, whether it's an uptrend or a downtrend. But the indicators are now mathematically showing you that. They also monitor the trend, the strength of the trend. So the histogram's height and the direction can be used to provide that insight into the momentum behind the price movements. Now, there are also crossover signals, right, which show you the shift in trend. So if the MACD line crosses above the signal line, it shows an increasing trend. So if this is a MACD line, if this is a signal line and the MACD line crosses above it, right, that shows strength, or it shows that there is an increasing momentum. Now, if it crosses below the signal line, it shows that the momentum is reducing. Now, here are some key takeaways I want you guys to remember. MACD is one of many tools that can help investors analyze the market trends and the momentum, but it should not be used in isolation. So this is what the MACD looks like. So what I have here is the S&P 500 in its current state as of this morning or yesterday, and it shows you what the MACD is showing. So the dark blue line is the MACD line. So I'm using TradingView, and you can just add that as an indicator. All I've done is in the MACD line, I've increased the size of that or the thickness of that line so I can easily remember that this is the MACD line. The red line indicates a signal line. Remember, the signal line is a 9 EMA. So what is this telling you? And let's look at it in conjunction with the behavior of the S&P 500. Now, you remember here when we said that when the MACD line is above the signal line, that indicates a bullish momentum. So where is that happening? Let's look at it from here, this point onwards. So for most cases, or for most of the time, the MACD line is above the signal line all the way up till here. And notice what happens in the S&P 500. S&P 500 goes up, or up till somewhere here it goes up. And then there's a crossover, and then the MACD line goes below the signal line. And then look at what happens to the S&P 500. It goes down. Then it changes trends again, and it goes back up, and it goes back up, etc., etc. And this is also on a weekly time frame, which is what long-term investors, it would be helpful to look at in a slightly zoomed out way to see the long-term behavior. Now, then the signal line, the MACD, kind of went on a sideways, went up and down, went sideways. Now, at that same time, remember, the S&P 500 continued its upward trajectory. So that means you can't just look at the indicator by itself. You got to look at this thing as a holistic fashion. Recently, around sometime late December last year, the MACD line crossed below the signal line, and soon after that, the S&P 500 started dipping. Basically, that shows that the momentum was starting to die out. So folks, that is the MACD. The other one I'm going to bring to your attention is called an RSI, which stands for Relative Strength Index. This is also a momentum indicator that measures the speed and change of price movements. An RSI is between 0 and 100. and it's commonly used to identify whether a certain stock or an index is in the overbought or oversold territory. Remember, MACD was showing the momentum. RSI is showing whether this is overbought or oversold, okay, based on the volumes, etc. Typically, when you apply this indicator in, let's say, TradingView, the very typical values that it'll use are 70 and 30. Okay, so 70 and 30. Basically, if you just stick with those, it's essentially showing that whenever the stock is above 70, it's indicating that it may be overbought. I want to inform you as well that many times, many stocks remain in the overbought territory and they keep growing, right? It's not necessarily an indication that you should sell. It's just giving you some information about the stock. So when it's above 70, that means the stock is in the overbought territory and the price has risen too quickly. That's what it shows. If it's below 30, that means it's in the oversold territory and the price has fallen too quickly. And if it's between the 40 and 60 zone, that's a neutral zone, which means this is often what's seen in steady trends. So how can long-term investors use RSI? They can use RSI to identify potential buying opportunities. So when RSI drops below 30, it may indicate that there is an excessive selling pressure. So let's say if it was below, let's say here's 30. So if it went below, but if it goes right back up of it, then that can start to indicate that, you know what, maybe this could be an entry point. Again, as long-term investor or as any wise investors, it's always wise to confirm with fundamentals before start acting to buy. Now, the second is if it's over 70, which means it's overbought, what you could do is you could say we're going to avoid buying at overheated prices. So if a stock's RSI is above 70, it might be in a strong uptrend, but investors should evaluate the valuation and business performance before making any decisions. You cannot use this in isolation. You got to use this in conjunction with other things. Let me show you what RSI actually looks like. So this is a snapshot of RSI from TradingView. Again, this is just standard. I didn't change anything. So here it shows 70 and 30 as the floor and the ceiling. And let's see what S&P 500 shows when the stock was in these patterns. So you notice here, for a while, the S&P 500 was in the overbought territory. Soon after it went down, and notice what happened, the stock also went down. But it remained in overbought territory for a while. So just by looking at S&P 500, its RSI, you can't say that, oh, it's gone above 70, so I'm going to sell. Imagine if somebody had sold here, they would have lost out on this growth trajectory, right? Just for you to keep in mind. But then came a point where the RSI started to go down, which followed with the S&P 500. Then it just barely touched the oversold territory. It didn't go below it. So it touched the oversold territory, and which was right here. While the S&P kept going down, thereafter it kept going up. So again, not an exact indication of when the turnaround happens. This is why when I told you that I had done back testing using Python, the long-term behavior did not give me strong enough indication that we could make buy and sell decisions based on an indicator or a couple indicators. It's got to be looked at holistically. So if I look at the RSI again, notice here at this point in 2024, the RSI was at an overbought territory. But did the stock market turn around? No, it did not turn around. Notice it kept going up. It kept going up. So again, it's got to be looked at in conjunction. So that's exactly what I'm going to do now in my next slide, which shows you the MACD and RSI together. So here's MACD and RSI along with the S&P 500. And because the TradingView only allows me 2 indicators, I'm only able to show those 2 together. But you guys can do it one at a time as well. So you can just look at the long-term trends using the indicator that I have shared with you. Okay, so let's look at this. So right here, so the S&P 500 went down, right? Notice that the RSI was at an overbought territory. So prior to this, the S&P 500 was increasing, and for some time. RSI was at an overbought territory. But look at what's happening in the MACD line as well. MACD is not going up. It's also at a sideways trajectory. Does it indicate maybe that the momentum is losing? Yeah, you could say that. Notice that the histogram had turned red. So while the S&P 500 was moving, histogram had turned red. Now, as an investor, long-term investor, you're not necessarily saying that, okay, I'm going to start selling, but it could start giving you an idea that, you know what, maybe a buy opportunity is about to come. Right? right? Because you want to buy stocks below their fair market value also at a dip. So it give you that indication. So if you were to buy at this time, or if you had certain money to invest, you'd say, maybe I'll wait for a bit. But how long did it go down before it turned around? So it turned around somewhere here. Notice it turned around somewhere here, correct? What happened in the market? There were you got a positive here, you got a positive here, and you got a positive here. But also, the MACD line had crossed over the signal line at this point, but the stock still kept going down, S&P 500. It crossed again positively here, at which time it turned around. And the momentum of RSI, or the direction of RSI, was also higher. What does that tell you? You're not able to pinpoint exact location. But if you were to zoom out, this is on a weekly chart. If you were to zoom out, you can say, okay, long-term trajectory, what is that? You start to get an idea. In the S&P 500, there is an uptrend. If you were to look at the moving averages, they would show a clear fan, which is 50 above 100, which is above 150, which is above 200-day simple moving averages. So it's showing you that view. But you can also get some additional confirmation using the indicators showing that it's also at a high trend. Recently, it went down, right? So something would have happened in the simple moving averages as well. Some of the simple moving averages at the weekly chart would have turned down. And that's also being indicated by the RSI. The RSI is not necessarily showing that it's at a super oversold territory. That should be close to it touching 30, which it hasn't yet. But it's certainly on its way down, which means if the market were to continue down, it's probably close to the bottom. But because the stock market or a stock can continue in an uptrend trajectory in an overbought territory, it could also carry on a downward trajectory in an oversold territory. So again, what you want to do now is you want to also combine these with regular supports and resistances. So how would we do that? So let's look at it. So here is a swing low. Here's a swing low. Here's a swing low. So notice that if I were to draw a line here, this swing high became a swing low, right? So in other words, this resistance became a support. Here again, right here, this resistance became a support. So right now, the stock is at, the S&P 500 as of yesterday was at 5,700. So it's currently below, it's currently below that resistance. So if it breaks forward, or sorry, I should say that this chart as of the moment I took the snapshot was below that. So for it to break above it and create a bullish momentum, from a stock chart point of view, this resistance has to turn into a support where it would probably come and be tested once more and then it go up. And what's going to happen in the MACD and RSI? Well, MACD line will likely some point in time cross over the signal line and turn in and show a positive slope, which means it starts sloping upwards. And the RSI is also going to some point in time turn upward to show that it's an established uptrend. So folks, that brings me to the end of today's presentation. Please, do you guys have any questions? What do you think of it? And also, you guys are all part of our Telegram channel. Feel free to ask questions if any of you missed to ask anything. Go ahead, guys. And I know I covered a lot. I just kept speaking nonstop. But anyhow, guys, any questions?
Yes, Amit. It's Deepak here. Good afternoon.
Where are you from?
Toronto.
All right.
So I was wondering, because I must have heard that book, Random Walk Down Wall Street. So I'm just wondering how accurate technical analysis is. Is it like part of the pie? Or because if it was perfect, the banks would have rooms of people running technical analysis and making money all the time. So how accurate do you think technical analysis is? Thank you.
So technical analysis is, what is its accuracy? They are basically, I have not seen any technical indicator as a leading indicator. Almost every technical indicator that I've seen is a lagging indicator, which means something has already happened in the market for then thereafter the indicators to show something. So for example, let's say the stock goes down a lot and the indicator is using exponential moving average. Let's say if it's like the MACD, which is using 26 and 12 or whatever, right? That means it's really not going to change until those few days have gone by for it to show something. So it's a lagging indicator. How accurate are they? I like to say that the technical analysis is really an art of reading stock charts. It's not a science. There's nothing exact about it. But that's why if you look at the technical analysis holistically, using a few indicators together, using the performance of the market, and if you're investing in a specific stock, you also look at what the fair market of the stock is by actually calculating and looking at the financial projections. You start to get an idea. A lot of traders hope that they buy a stock at the very bottom. But the fact is, it's very difficult to pick up a stock at the very bottom. If you high level, you know that I've got the stock at somewhat close to the bottom and you never deployed all your money in one shot, in the long run, you're going to be okay. But what a lot of traders do is this, and this is why they lose money. They're like, when the RSI hits 30 and the MACD crosses over the signal line, I'm going to buy. And they buy like, put all their money. Then you're gambling, my friend. Then you don't know if it carries on going down and how much you're going to lose. Do you know a lot of traders actually don't even know what stop losses are, how much risk to take? No wonder people lose money. So investment, the game of the stock market, is actually the movement of money from the pockets of inexperienced and eager people to the pockets of experienced and patient people. Okay. But in the long run, like if you look at how the S&P has behaved, 23% return last year, right? North of 40% the year before. Like it's behaved phenomenally. But there are a lot of ups and downs. Market had all kinds of bad news. Anyways, hope that answered your question.
Amit, I was going to just say I've followed you, and your technical analysis, the way you deliver is amazing. And thanks for simplifying it. And it's very exciting.
Thank you for taking time out of your valuable day and busy schedule for listening to us. Thank you.
Well, just one more question.
Asya, go ahead, please.
Yeah, for the MACD and RSI, is there it works in any time frame, or when you look at MACD, does it have to be like an hour or 15 minutes?
Do you still see my screen?
Yes, yeah.
Perfect. Okay. So let's do this right now. So here's my MACD. I'm going to turn off my indicator. By the way, I programmed an indicator for you guys, so I'll also put a link to that in the chat. It's in our Telegram, so please join. So basically, when you click this, it'll automatically show you all the simple moving averages along with the exponential moving averages that I spoke about today. So let's look at SPY, which is the S&P 500. So I'm going to unclick this, and here's MACD. So right now you're seeing MACD on a monthly time frame. So your question was, does it only work in one simple time frame? The answer is no. Monthly, I can go to 1 week. It'll show you a different MACD based on the candlestick patterns here. You can also change the same thing to a daily candlestick. So here, every candlestick represents a day, 1 day. Now, as long-term investors, consider slightly higher term because we're not that concerned with short-term fluctuations. Remember, we are in the market for the long haul. We're not in it to say I want to make $50 today. I'm saying I want to make a consistent, certain return on an ongoing basis. So if I were to now convert this to a weekly, check this out. It's showing that in a weekly time frame since December, we've had a downward momentum. But what if I were to convert this into a monthly? The MACD line is up.
Yeah.
It has not crossed a signal. So that means if you look at the long run, there's a bullish momentum. Now, let me flip this around and let me show you that, let's say you didn't know anything about MACD or all this. Let's just look at simple moving averages. Ultimately, that's all I look at. Okay?
Okay.
Here's simple moving average. Check it out. It's on an upward trajectory. Look at all the moving averages are fanning properly. And this is on a monthly time frame. If I were to now look at a weekly time frame, even then it's a positive, it's a bullish moment. It's a bull market. Let's see what happens if I go to a daily time frame. In a daily time frame, the story starts to look a little different, albeit not too different. Look, the 200-day simple moving average is up. While the stock price is below the 200-day simple moving average, the slope of the 200-day simple moving average is positive. That means it's still a bullish momentum, or I should say it's still a bull market. A downward trajectory is if the slope of the 200-day simple moving average went downwards. When did that happen? Watch this. Look at this. Here, on this specific date, April 27, 2022, the stock market, the S&P 500 was below the 200-day simple moving average, and the 200-day moving average sloped downwards that day. This was a day when somebody who knew how to do technical analysis would have said, oh, it's a downward trajectory. But there are also early indicators. What are the early indicators? It's called a crossover or a golden crossover. So if the 50 crosses 150 SMA, it gives you an early indication, right? And I'm not making this up. You can just chat GPT it and Google it. It's all out there information. So look at this. The 50 is green. So look, 50 is green and 150 is blue. So when did green cross blue? Right here. Green cross blue on the 3rd of March. But both of them have to be sloping downward. So it was sloping down. It started sloping downward somewhere around 9th of March. So you would have gotten an indication almost 2 months before the 200-day moving averages movement, right? I was able to figure this out when the downturn turned into an uptrend. Nothing, this is not new. These are established trends. You just got to know how to read them. Okay.
Thank you.
No problem. All right. Anybody else? Any questions? Thank you for using your lunch hour with me.